Hello, folks. Brandon Chapman today. It's a Thursday Theo Nightly video for TheoTrade, I guess, right? Anyway, interesting day. The title of today's session is Markets Fade. Generally, as retail stock chaos is now on deck. So we'll kind of look at some of what's going on. If you look at the course of action throughout the trading day, as we kind of go to like a 5-minute type chart here today, you'll see that ultimately the initial open wasn't all that bad. And we kind of glided along for a little while. And then the selling began. And then we started to recover. And then into the close, we wilted. And ultimately, as of right now, at the lows, close to the lows of the session. So it's not necessarily been a great day for the market, which sometimes for some investors or traders is actually a good thing. But here's the wrinkle, right? Sometimes when we sell off, it doesn't happen with a lot of fanfare. And when I say fanfare, we're talking about hedging. So when we look at the VIX as an example, the VIX today, even though the market tested new lows, at least in the last week, did not necessarily take off here. In fact, it finished at a very similar level as we finished the other day. An important lesson to learn is that ultimately, the VIX does not trend with the stock market. That hedges that were put on back on the 20th may be covering some of the risk that's going on today. But the fact of the matter is, the selling was relatively orderly. If we look at, for example, the advance and declining, we got about double the declining issues than advancing issues on about double the volume. This wasn't exactly a day that was marked by a lot of just people just throwing out the kitchen sink. This was a day that was fairly orderly in its decline. As a function, the VIX did not go up a lot. Now, this does open the door a little bit. When you look at skew as an example, yesterday it ticked to about 137. It's the lowest level it's been since last April, kind of May back here, earlier this year. The fact is it's still high, it's just lower as some of the protection that's been put on has rolled off since the September's expiration, which was kind of a big deal. Now, the fact is that if we're less hedged today, it does open it up that if the market starts to decline quickly, we may see further panic selling. And in that case, we might start to see the bigger potential move in the VIX. The thing about this today is it just didn't happen today. As you look at the sectors that in their performance on the session, red across the board, with staples being one of the worst performing sectors, along with industrials. Well, when you look at their 1-week change, you start to realize these were some of the better performing parts of the market. The worst performing, and energy's in this mix as well, down 1.5%, being the best. But then you got some areas like, for example, technology that's really taking it on the nose. Today, it did fade, but the point is that it performed relatively better. Why? Because it's been selling off harder over the course of the last few days. As we look at the Nasdaq /NQ as an example, finishing near the low of the session, but holding up relatively better. Google, for example, tried to see a little bit of strength early, but then all of a sudden wilted as the day went on, finishing at new lows. As we look at the Russell /RTY, you'll see again, as we're rolling back from the highs, there was some bearish activity that occurred the other day, angling for the lows down here on the Russell, specifically traded at an IWM. We'll see if we can get there. But there's been some downside shots early in the week, predominantly what? Just using long put verticals as hedges. When we talk about hedges, one of the things that we can look at is the SPX, since this does very directly tie to the skew. I read an article here today talking about some of the big interest out here as a caller on the 30 SEP expiration. You can see it in here, 45,000 contracts of the 4065. We scroll down here to the 3,400 area at the 3,425. You'll see again, 45,000 contracts. We scroll up to the call side over here, and you'll notice at the 4430 strike, got to scroll up just a little bit. Right here, 46,000. We're talking about a 45,000 contract caller where you're selling calls and buying put verticals expiring today. Now, when you look at where this might go, well, normally a lot of this stuff goes from quarter to quarter, and you'll notice out here, for example, on the D's quarterlies, you'll see those 45,000 contracts right here at the 3440. You'll see as we kind of scroll up here, 91,000 right there at the 3480, for example. We kind of scroll up here, 45,000 at the 4080, and then you start to roll here out of the middle of the call side, 45,000. So again, that 45,000 contract caller appears like we're letting the SEP 30 expire. We're putting on the DS 30. And so as we talk about skew, you have to realize that skew is a function of what? It's a function of those kind of collar type trades, even though this was a vertical to the downside. If you for TheoTrade members, they heard Don the other day talking about using long put verticals as a hedge in this market, and the exact same day you saw it on IWM and the SPY. A lot of big hedges being put on for the downside as a vertical. In this case, it's a collar. So again, what we're seeing right now is that the market itself is not as extreme in terms of the potential pressure, which basically tells you what? We're not exactly looking like we're at lows. Yes, we're at support. We're testing the low from September 20th. Tomorrow, however, we'll see how we progress. Do we start off right off the bat seeing a really ugly open where you might have 9 to 10 times more declining issues on 9 to 10 times more volume or higher? Again, you can see that by going to Market Watch here. Again, you'll see these numbers reflected. Is that the kind of open we're going to experience, or do we start to see the open bid, and then how does it progress? Does it progress like we saw yesterday and we fade late, or like today, we progress okay on the open and we just continue to sell off throughout the day, and then we finally started to break the low here? We saw, again, further selling, but no panicking, right? Some stocks still did okay today. Now, for some stocks that did not do okay, one of those stocks is, of course, Bed Bath & Beyond. And this is kind of like the canary in the coal mine. Now, Bed Bath & Beyond's historically had a lot of exposure to China in terms of tariffs and supply disruptions. These can all be factors here. But the fact of the matter is the company missed and missed badly. And we're talking what? We're talking on net sales. We're talking about adjusted EBITDA, EPS. We're talking about cutting guidance in a very significant way. It was a really, really ugly earnings, and the stock paid the price today, down 22%. There may yet be more downside in this company coming forward. Certainly, it's been rather weak in the past. Clearly, the turnaround that they had talked about back in 2020 and really 2019 is not necessarily coming to fruition. And ultimately, we're seeing some downside trajectory for Bed Bath & Beyond. Interestingly enough, the CEO called this just a pothole in the road. Fact of the matter is, looking at a 22% decline, I'm sure a lot of investors are probably calling it a sinkhole, okay? But this really has broader ramifications. The fact is that, many people have been warning about profit margins. Morgan Stanley, about a month ago, predicted about a 20% correction in stocks because of margin compression. We're seeing inflation being a factor and supply chain disruptions for many of these companies. Of course, Jay Powell or Jerome Powell, Janet Yellen, it's a meeting before Congress today. Chairman Powell basically saying factors pushing inflation could last until next summer. I guess he would know because he's contributing to it. In fact, if you saw him last week, he looked a little bit giddy when it looked like they were surpassing their target of 2%. We saw GDP today. GDP came in slightly better in the third and final revision at 6.7% versus 6.6%. The GDP deflator was at 6.1%. We have not seen that high of inflation pulling back on GDP in the 20 years that the data set that I was looking at had shown. This is the highest print in terms of inflation we may have seen for we're talking decades and at least the last 20 years. Now, what does this mean? When we talk about retail, can people pass on this higher cost? Well, Disney, DIS, if we look at Disney today, rolling towards support, maybe looking to break out here. Disney is an example. They're launching their Galactic Star Cruiser. It's like this Star Wars hotel experience. A party of two adults, $4,800 for 2 nights. You get a family of 4 with 1 adult, you're chalking $6,000. Are people going to be able to pay that? Maybe there are some that can. And maybe this helps Disney. They're looking to book around October 28th, starting October 28th. But the reality here is Disney was down over 2%. We're seeing inflation kind of enter the picture. As we look at some companies, like, for example, XRT, this is the retail sector ETF down 4.75. You can see the carry-on effect from Bed Bath & Beyond today. And in fact, if you look at the options, we look at today's statistics, the put side, most of it occurring between the market. But as you look at the time and sales, what you'll notice here, an 87.80. This is a long put vertical, buying the 87, selling the 80, looking for downside to 80. You also notice this 19.0 fill between the market, but again, indications of what? For November, looking for downside. And you'll see that extra 2,000 contracts there, kind of backing up from that 89 strike. What does this tell us? Could 80 be a possibility by November? Absolutely. Could be below 80 be a possibility as well. Yes. Right? Dick's Sporting Goods today, DKS. Again, breaking a key level of support, already announcing earnings. We bounced off it, we came back to it, and today we broke through it with a 5.75% decline. And part and parcel of it, this morning on Dick's, for example, was the 8 October expiration, the weeklies here. And you'll notice here about 2,000 contracts. This was actually filled in one print for about 230. It was a significant size trade. This option is now going for what? Bids 3, the ask is 340. Up about $1 since it was placed earlier this morning. But again, what does this tell us? Again, looking for downside in Dick's, right? The retail space. Now, here's the deal, though. Not all of retail is quite as extended. You look at COTY as an example. COTY had a very big gap here just recently, and we're kind of backed up against the support here. Now, not all retail may be affected the same. Some may weather the storm better. Some may have better online presence. Who knows, right? But today in COTY, really on no news, and the price really didn't respond all that positively. We'd have to come out here a bit to specifically the 18 February expiration. We're talking 32 contracts traded today. And if we look at the time and sales down here, what you'll see, 25,000 traded in one print. That was a buy order, right? So we're buying options out here at the $9 strike for somebody's projecting some upside here in COTY. Maybe it pans out, maybe it's not. The stock did not necessarily respond. It responded intraday, but didn't carry it through to a higher close. But again, could we see a rebound to 9? Yeah, absolutely. By February, a very real possibility. But again, at least somebody's taking some bullish shots here. Whether it's going to pan out or not, you don't know, but it's an emblematic of some big money coming into COTY today. Finally, we're going to finish up with IYR. This is real estate. Of course, real estate's been struggling of late because of rising treasury yields. So, for example, if we look at the 10-year treasury note yield, we've been kind of hanging out here, but we saw a pretty big sell-off in treasuries since the Fed statement last week. We're kind of reshuffling the deck chairs on this Titanic. Anyway. But when you think about IYR, a few things to consider here. For example, mortgage rates just went over 3%. If you account for home price increase, for example, and I realize this is a REIT, but if you account for just residential home price increases over the course of the last year and the tick up in mortgage borrowing costs and rates, you're talking about another $150 more a month in your payments. That's a big deal for the last year. And so we look at IYR, has sensitivity if borrowing costs go up. Well, guess what? If you look at high yield credit, it had a pretty big down day. Of course, there was some significant bearish activity that came in on the 27th. We got the sell off the next day. We held. Now we're starting to wilt. If this starts to come in, if we start to see, LQD, corporate investment grade bonds, look what's happening here. They're selling off. And despite the fact that treasury yields are holding, we're not seeing corporate investment grade bonds hold, which means we may start to see spreads wide out. It could mean higher borrowing costs, and that is not great for IYR, and not to mention the potential default. So guess what happened? So today in IYR, we're talking a 15 October expiration here, and this is a roll. So there was a 33,000 contract position at 104, 101. This got rolled down to what? It got rolled down to 102.99. So all this is saying, look, they're perpetuating their bearish position, maybe taking a little profit out of it, but the reality is now we're opening up the expectation we might go to 99. And of course, if things get more ugly, this could devolve from there. All right, so let's circle back here. So what do we look for going into tomorrow? It's an option expiration, right? It's the beginning of a new quarter. We could very well see some buying on the open. The biggest thing we want to see is, how does it trade? Does it trade like we did today and like yesterday? In that case, we may head lower. Watch the support here. Again, you could use SPY, you could use /ES. If we start to take out, for example, the low of 9/20th, we could open the door for more selling. But watch the VIX. See how panicked the market is. Watch the breadth of the market to see how panicked it is. We talked about seeing 90% of the volume on down stocks and 90% of the stocks declining. That's the kind of stuff that builds the more durable bottom in the market. But again, it's going to take a little bit to get there. Anyway, folks, it's been a pleasure doing this video for you. We'll catch you back another